All right, so let's dive into this market analysis from last week,
Okay.
February 24th to the 28th,
Right.
to be
Okay.
exact.
Yeah.
You know the one where everyone seemed to be kind of holding their breath, wondering which way the market would jump next?
Yeah.
Let's talk about a roller
It
coaster.
really was a week of contradictions, wasn't it? We had
Yeah.
positive job numbers coming out, yet there was this underlying tension, this
Right.
feeling that something else was brewing.
Exactly. It was like a tug of war between optimism and uncertainty.
Yeah.
So before we get into the nitty-gritty, can you give us a quick snapshot of what actually happened
Sure.
across the major indexes?
Well, the Dow Jones managed to close slightly up, a tiny 0.08% gain to end at 43,461.21.
Okay.
But don't let that fool you. It took quite a ride to get there.
Oh, wow.
The S&P 500, however, wasn't so lucky. It ended down 0.50%, marking its second week of decline, closing at 5,983.25.
And the Nasdaq. That one took a harder hit, right?
Unfortunately, yes, the Nasdaq closed down 1.21%, its third consecutive week of decline, ending at 19,286.93.
Okay, so definitely some mixed signals there. But what were the real forces driving all this volatility? The report mentions tariff threats, economic data inflation worries. It's almost too much to process.
It is a lot to unpack, but essentially these factors are all tangled up together. For instance, think about President Trump's ongoing tariff threats, particularly those aimed at Mexico, Canada, and China.
Right.
That creates a massive amount of uncertainty for businesses that depend on global supply chains.
And that uncertainty trickles down to investors. It makes sense. Who wants to invest when the trade landscape could shift overnight?
Precisely. And then you add in those mixed economic signals we talked about. Consumer sentiment hitting its lowest point since November 2023.
Wow.
That's not a good sign.
Yeah, that sounds like a major red flag to me.
It is, but then on the flip side, we have a strong January jobs report. It's enough to make anyone's head spin.
Talk about a mixed bag. So how does inflation fit into all of this? The report highlighted that it remains above the Fed's 2% target, right?
Right. And the Fed's recent decision to hit the pause button on rate cuts just adds fuel to the fire. Are they worried about inflation spiraling out of control? This uncertainty makes investors jittery, especially in the tech sector, which is known for its sensitivity to interest rates.
And to top it all off, the Fed's only projecting a 0.5% rate reduction for all of 2025. Doesn't exactly inspire confidence, does it?
No, it doesn't. And this lack of clear direction from the Fed definitely contributes to the market's volatility.
So with all this doom and gloom, were there any bright spots last week?
Actually, yes. We saw a classic flight to safety with investors flocking to defensive sectors, like utilities and consumer staples. Think companies like Procter & Gamble or Nexter Energy, those steady Eddie types.
Makes sense. When the market's rocky, those predictable companies start to look pretty appealing.
Exactly. They ended the week up 0.3%. But on the other side of the spectrum, technology took a pretty hard hit, down roughly 2.5%. Those high-growth tech stocks, especially the ones with high valuations, like Nvidia and Alphabet, really felt the pressure from rising bond yields and, of course, those tariff concerns.
So it sounds like the market was saying slow and steady wins the race last week.
That seems to be the message, at least for now. Healthcare was another interesting sector to watch. It only slipped worse 0.5%, showing surprising resilience in this environment.
Wow, that is impressive considering the overall market downturn. What about the financial sector? How did they fare?
Financials ended down 0.2%. They were caught in a bit of a tug of war with those higher interest rate expectations, which are generally good for banks battling against fears of an economic slowdown.
So a bit of a push and pull there. Now ready for the juicy details. What were some of the standout stock stories from last week?
Well, Palantir's plunge of 10.5% was definitely a head-turner. It seems their growth forecasts didn't live up to the hype, which can be a death knell for a tech company in this climate.
Ouch, that's a rough week. The report even called it the S&P 500's biggest loser. But hey, at least Nike had a good week, right?
They did indeed. Nike jumped 4.9%, and that's got to make some investors pretty happy. Analysts are attributing this to their improving profit margins and a positive outlook for future earnings.
It's a nice reminder that even in a turbulent market, there are still winners out there. And then, of course, there's Warren Buffett. Berkshire Hathaway was up 4%, proving once again that he can weather any storm.
Berkshire Hathaway's diverse portfolio is a key factor in its consistent performance. It's a great example of why diversification is so important, especially when market volatility is high.
It's a lesson we could all stand to learn from. Speaking of lessons, Tesla's 4.5% dip is a good reminder that even the most innovative companies aren't immune to market forces.
That's very true. Tesla is facing a number of headwinds right now, from those ongoing Cybertruck recall issues to the potential impact of tariffs on their global sales.
And those headwinds seem to be affecting other tech giants as well. NVIDIA, for example, dropped another 3.1% on Monday.
Yes, NVIDIA's decline was part of a broader tech sell-off. Investors are worried about the company's high valuation and the potential impact of tariffs on its supply chain.
So far, we've focused on stocks. But what about the bond and commodities markets? What were they telling us last week?
The bond market initially saw a flight to safety with the 10-year Treasury yield dipping to 4.40% on Monday. This suggests investors were looking for a less risky asset amidst all the stock market volatility.
Makes sense. When stocks are shaky, bonds can seem like a safe haven. But did that trend hold up throughout the week?
Not entirely. By Friday, the 10-year yield edged back up to 4.42%, signaling some renewed confidence as investors digested the week's economic data.
So bonds were kind of like a mood ring for the market, reflecting those shifting sentiments. What about gold? Was it still holding its shine as a safe haven asset?
Gold remained relatively steady at around $2,970 an ounce last week, solidifying its role as a safe haven asset.
It's good to know that some things remain constant in this crazy market. But did the turmoil in the U.S. market spill over into other parts of the world?
Unfortunately, yes. Global markets felt the tremors of the U.S. market's turbulence. European indices declined. Asian markets were mixed, and emerging markets faced even greater challenges.
It's a reminder that even though we talk about different markets, we're all really part of one big, interconnected global economy.
Exactly. What happens in one corner of the world inevitably has ripple effects elsewhere. It really does highlight how interconnected things are, but zooming back into the U.S., what happened in Europe specifically?
Well, European indices definitely weren't immune to the jitters. Both France's CAC and Germany's DAX posted losses pretty much mirroring the trends we saw here in the U.S.
That makes sense, especially given the concerns about potential tariffs impacting global trade. What about Asia? Were they feeling the heat as well?
It was a mixed bag in Asia.
Mm-hmm.
Japan's Nikkei fell, which seems to be in line with the weakness we saw in the U.S. tech sector. But China's Shanghai Composite was a bit more unpredictable, fluctuating throughout the week as investors grappled with domestic policy changes and those ever-present tariff uncertainties.
So a bit more of a roller coaster ride in China. What about those emerging markets you mentioned? How are they impacted?
Unfortunately, not well. They faced additional headwinds from a stronger U.S. dollar, which can make it more expensive for them to service their debt. Plus, the potential fallout from global trade policy changes adds another layer of risk. We saw declines in indices like India Sensex, for example.
It sounds like a rough week for emerging markets all around. But let's shift gears a bit and look ahead. What are some of the key factors that could influence the market in the coming week?
Well, the report emphasizes that upcoming economic data will be crucial, especially the personal consumption expenditures, or PCE inflation index.
Ah, yes, the PCE. It's the Fed's preferred measure of inflation. This data will be closely watched for any signs that inflation is cooling down or, conversely, if it's continuing to heat up.
Right. And on top of that, we'll also be getting consumer confidence figures. Those will give us a better understanding of how people are feeling about the economy and whether they're planning to open their wallets or tighten their belts.
Exactly. And all of this data could also influence the Fed's next move on interest rates. Speaking of the Fed, their stance on rates is going to be a major factor to watch in the coming weeks.
Absolutely. If inflation remains stubborn, the Fed might be forced to keep interest rates higher for longer, which could put a damper on stock market growth.
Precisely. But on the other hand, if we see some signs that inflation is easing, the Fed might adopt a more accommodative stance, which could give equities a boost. It's all about striking that delicate balance between keeping inflation in check and supporting economic growth.
It sounds like a real tightrope walk for the Fed.
Yeah.
But let's not forget about corporate earnings. Earnings season is still in full swing, and next week we'll be hearing from a lot of retail and tech companies.
Yes, those earnings reports will be particularly interesting, especially with all the concerns about how tariffs might be impacting consumer spending and overall corporate health.
I'll be keeping a close eye on those reports for sure. And then, of course, there's the big elephant in the room, those looming tariff threats.
Any progress or escalation in President Trump's tariff agenda will be a major market mover in the coming week. We're all holding our breath, waiting to see what happens next.
Because, let's face it, clarity on trade policy could either calm the markets or send them into a tailspin. It really is a pivotal moment. So given all this uncertainty, what does this all mean for the average investor? I have to admit, I'm feeling a little overwhelmed by all these moving parts.
It's completely understandable to feel overwhelmed. Last week was a prime example of just how complex the market can be. There are so many interconnected factors at play, and things can change so quickly.
It really is like a giant puzzle where each piece affects all the others. So what can investors do to navigate this turbulent environment?
Well, first and foremost, remember the importance of diversification. Don't put all your eggs in one basket, as the saying goes. Spreading your investments across different asset classes, stocks, bonds, real estate commodities, and so on can help mitigate risk and potentially improve your returns, especially during volatile times like these.
So diversification is key. What else should investors keep in mind?
Stay informed. Keep your finger on the pulse of the market, but don't get caught up in the day-to-day noise. Focus on the long-term trends and fundamentals, and remember that market fluctuations are normal.
Easier said than done sometimes.
Yeah.
But I agree. Don't panic. Stick to your investment plan.
Exactly. And if you're feeling unsure or overwhelmed, don't hesitate to seek guidance from a financial advisor. They can help you develop a personalized investment strategy that aligns with your goals and risk tolerance.
That's great advice. There's no shame in asking for help, especially when it comes to something as important as your financial well-being. It's like having a trusted guide to help you navigate those market ups and downs.
Exactly. And speaking of ups and downs, I think this is a good segue into a final thought for our listeners to ponder as they go about their week.
Okay, I'm ready for that final thought.
All right. Well, we've spent a lot of time, discussing external factors like tariffs and inflation, economic data, all that stuff.
Right.
But sometimes I think the most powerful market mover isn't something that we can predict or control. It's human psychology.
Oh, you're talking about those emotional undercurrents. That can drive market behavior, right? Fear, greed, hope, doubt.
All those primal instincts that can sometimes lead investors to make irrational decisions,
Yeah.
almost creating like a self-fulfilling prophecy.
It's like a collective mood swing
Right.
that can sweep through the market, sometimes defying all logic and rational analysis.
Exactly.
It's a powerful reminder that the market is driven by people, and people are complex and often unpredictable. So as we observe the market's twists and turns in the coming week, it's important to consider not only the economic and political forces at play, but also the powerful undercurrents of human emotion.
Well said. Understanding human psychology can give investors a real edge in deciphering the market's often perplexing behavior.
It's like adding another piece to that giant puzzle we were talking about earlier. So as we wrap up this deep dive into the turbulent world of the stock market, I want to leave our listeners with one final thought. The best investment you can make is in yourself and your knowledge. The more you understand about the markets, the better equipped you'll be to make informed decisions and navigate those inevitable ups and downs.
Couldn't agree more. Knowledge truly is power when it comes to investing.
So keep those minds sharp and those portfolios diversified. And we'll see you back here next week for another deep dive into a fascinating new topic.
Until then, happy investing.